Business owners, are you paying more taxes than you actually have to? Well, 90% of the business owners I talk to are, and by the end of this video, I want you to discover if you may be one of those individuals. My name is Sherman the CPA, and I specialize in tax planning for business owners with at least $100,000 in income over at mycpacoach.com. And every single day I'm on the phone with small business owners to help them reduce their tax liability. And typically, in order for me to do this, I start by reviewing the last tax return they filed to see what deductions they are missing. And literally 90% of the time, I find several missing tax deductions or strategies which end up costing them an extra $15,000 on average in additional taxes. That's $15,000 more that they're paying because they're not taking advantage of legal tax strategies that are available to them in the tax law. So today I want to help as many people as possible avoid these costly mistakes by sharing my top list of missed deductions by business owners. This may very well be one of my best uploads, so be sure to save this video for your own information and share it with someone you know who may benefit from this as well. All right, let's begin. The number one missed tax deduction is the home office deduction. Now, before you say, Sherman, I'm already taking that deduction, hear me out, because a lot of people are leaving a lot of money on the table with this deduction specifically. So first of all, what is the home office deduction? Simply put, the home office deduction allows business owners to deduct a portion of their home expenses as a business tax deduction. For example, if you have $100,000 of home expenses and use 20% of your home exclusively for your business, then you will be able to take $20,000 of those expenses as a business deduction. Now, let's talk about how most taxpayers leave money on the table when taking this deduction. Most of the time, business owners are either number one, not taking this deduction at all, number two, not taking the maximum deduction, or number three, not accounting for all of their home expenses. So let's discuss all three of these points quickly, starting with the people who choose not to take this deduction at all. Most of the time, people do not take this deduction because they are either not knowledgeable about it in the first place, which now you are, or they are scared to take it. And yes, even many accountants are afraid to take this deduction for their clients because they fear that it may increase their risk of an audit. So let's address the fear side of this deduction first. So first of all, there is nothing illegal about this deduction. It is quite literally a part of the tax code. The IRS even provides guidance on how business owners can take this deduction. So if this deduction is not illegal and is a part of the tax law, why would you not take advantage of it? In fear of an audit? Well, although I think that is unlikely, sure, let's go with it. Let's say you're audited and the IRS wants to learn more about this deduction on your tax return. And you did everything in accordance with their rules when taking this deduction. So if you did, do you really think you're going to be penalized for taking this? More than likely not. So I would steer away from anyone fear baiting you into not taking this deduction. And if it is your accountant, then I would seriously consider changing accountants. Now, the second big mistake people make with this deduction is that they do not take the maximum amount of the deduction that is available to them. And that's because the IRS gives taxpayers two ways to calculate this deduction: the simplified method and the actual expense method. And by the way, whenever you are presented with two methods to calculate something, always know this: one of those methods will save you more money in taxes than the other method. Anyway, in short, the simplified method caps your deduction off at $1,500 and the actual expense method does not. And 90% of the time, my clients have thousands of dollars more in home expenses than the $1,500 limit that the simplified method provides you. So if you or your accountant use the simplified method, then you will likely simply hand over more money to the IRS than you actually have to. And getting this wrong can cost you thousands of dollars more in taxes. For example, just ask yourself this. Hypothetically speaking, would you rather take a $10,000 home office deduction or a $1,500 home office deduction? More than likely, you would rather take the greater deduction, which saves you more money in taxes in the long run. Now let's address the third mistake, which is what I see more than anything, and that's not accounting for all of your home expenses. A lot of the times, people only account for their mortgage interest or rent expenses when calculating their home office deduction. But oftentimes they neglect additional expenses like their renters or homeowners insurance, their HOA expenses, utility expenses, telephone expenses, Wi-Fi expenses, repairs, and depreciation expense, which alone can easily add thousands of dollars to your deduction if done correctly. So be sure to include all of your home expenses. The IRS allows you to deduct direct and indirect home expenses to keep up and run your entire home. All right, I'd love to continue to rant about this deduction, but this is just one area, so let's move on. So the second most missed deduction is health insurance. When I ask most of my clients if they are deducting their health insurance premiums that they pay, they often tell me that they are not, or they did not even know that these expenses were deductible in the first place. But they are. Section 162 of the tax law allows self-employed individuals to deduct their health insurance premiums. Even if you are on a family plan with your spouse and or dependents, those expenses are still deductible if you are on that plan. So if you pay any portion of your health insurance premiums and you're not deducting your payments, then you may be overpaying in taxes. Now, the method for deducting your health insurance premiums will ultimately depend on how your business is organized. For instance, S Corps may create a reimbursement plan to reimburse owners for their health insurance premiums, whereas a sole proprietor may pay these expenses directly from their business bank account. So you will want to make sure that you take this deduction correctly to prevent any red flags, but nonetheless, this is a valid deduction that you can take if you are paying for these types of expenses. Now, the third missed tax deduction is self-employment tax. All right, so two big things here. Number one, yes, self-employment tax is deductible from your income. So if you owe self-employment tax, then this should effectively reduce the amount of income tax that you pay. But number two, if you plan correctly, you can avoid self-employment tax altogether by simply choosing the right entity. And to get straight to the point here, corporations don't pay any self-employment tax at all, and every other entity does. And S corporations specifically are what most savvy business owners elect to avoid self-employment tax. To illustrate, let's assume you made $100,000 in business income. Well, in this case, you would pay over $15,000 in self-employment tax alone. Whereas if you elect S Corp status, you would effectively avoid most of this tax. So by simply choosing the right entity, you can save thousands of dollars in taxes. And consider this, less than 15% of all the companies in the US are S Corps, which tells me that thousands of business owners are paying thousands of dollars more in additional taxes. Now, there are several requirements of an S corporation, and sadly, a lot of people who are S corps are not maintaining their S corporations correctly. The most overlooked requirement is the requirement to pay yourself a reasonable amount of compensation, which is subject to some payroll taxes. Now, normally these payroll taxes are immaterial when you compare it to the amount of the self-employment tax that you would otherwise pay. But still, you will want to make sure that you work with a tax professional that can guide you through all of this and the requirements to ensure that you are compliant. For my clients, I provide a side-by-side comparison of each entity and show them the exact amount of taxes they would save by picking the correct one and then I guide them through those requirements. Anyway, let's move on. The fourth most missed tax deduction are contributions to tax deferred accounts. Tax deferred accounts are accounts that allow you to receive a dollar for dollar tax deduction for every dollar you contribute to it. Now, most taxpayers who miss this deduction miss it because they fail to utilize these accounts altogether. But by literally moving money from your bank account to a tax deferred account can create a tax deduction for you when you file your tax return. So you may be wondering, what are some examples of tax deferred accounts? Well, here are the most popular ones. Number one, traditional IRAs, which is an individual retirement account. Number two, solo 401ks and SEP IRAs, which are self-employment retirement accounts with much higher contribution limits. And then number three, HSAs, which is a health savings account. And those are just a few, but there are several ways to defer income to the future, which effectively lowers the amount of tax you pay today. Another important thing to note is that you typically have until April 15th to make any contributions to these type of accounts for the prior tax year. For example, even though we are in 2023 at the time of this video, I have until April 18th of this year to make any contributions to these type of accounts for 2022, which means I would receive a 2022 deduction even though I'm contributing this money in 2023. But again, this has to be done correctly for this to be implemented. And you will also want to make sure that you understand the rules associated with the accounts you set up. All right, the fifth most missed tax deduction are tangible business assets or tangible personal property. Now, tangible personal property is simply property that can be felt or touched and physically relocated. Now, this includes the purchase of assets like business vehicles, equipment, appliances, and other assets your business may acquire in the pursuit of generating income. Now, typically, when you purchase an asset, you can only deduct a portion of the asset each year over its useful life through depreciation. For example, if you buy equipment that costs you $100,000 but has a 5-year useful life, then you would only typically be able to take $20,000 as a deduction. However, most taxpayers miss out on Section 179 of the tax law, which allows them to deduct up to 100% of the cost of qualifying property. So in this same example, you would hypothetically be able to deduct $100,000 of the asset you purchased under Section 179 instead of $20,000. And boom, just like that, you have $80,000 more in tax deductions. Now, there are different types of depreciation. There's Section 179, bonus depreciation, straight line depreciation, and so on, which means there are several rules associated with the different types of assets you purchase. So as I continue to say, make sure you or your accountant is knowledgeable of these rules and terminology to prevent paying for it at tax time. Now, let's move on. The number 6 most missed deduction is meal expenses. If you are not deducting business meals as business expenses, then you may be paying more than you have to in taxes. So if you have a meal with a business contact, whether it's your business partners, employees, customers, or prospective clients, then these meals are deductible. Now, in order for a meal to be deductible for your business, a business contact must be present and there must be a business topic discussed at the meal. If this is the case, then the expense should be deductible. And if you have a lot of meal expenses, then also make sure you maintain proper documentation. For example, for any meal greater than $75, you are required to keep up with the receipt. You should also keep a log of what was discussed or accomplished during these business meals in the event that the IRS has questions about them. The 7th most missed deduction are travel expenses. You can deduct 100% of your business vacation, travel, and lodging expenses. Now, the key is to make sure that there is a business purpose for the travel expenses that you incur. For example, let's say you traveled to New York for a 5-day business conference, but let's say you decided to stay there for 10 days to also mix in some personal vacation time while you're in the city. Well, in this case, you would be able to deduct your full flight expenses to get to and from New York and the 5 days of lodging expenses incurred while you were at the business conference. You will not, however, be able to write off any of your expenses during the other 5 days that you use for personal enjoyment. So a good rule of thumb is to make sure that you're doing some business each day during your business trip if you want to deduct 100% of those travel expenses. The 8th most missed deduction is the deduction you are not creating. All right, so look, all of the deductions we covered so far are deductions that you should probably consider claiming if you are not. But the reality is that there are far more deductions out there. And that is because some deductions are not just check the box deductions, but instead, these are deductions that you have to create through proactive tax planning. You can create many more tax deductions by carefully choosing how you invest your money, donate your money, and spend your money. So if you are looking for even more ways to reduce your tax liability after accounting for your standard business deductions, you can achieve this by creating deductions. For example, reinvesting funds back into your business to aggressively expand may increase your tax deductions and grow your business at the same time. You can also make tax-friendly investments by investing into things like real estate, oil and gas, or other tax-friendly investments. Likewise, if you donate to charity already, you can structure your donations in a way that provides greater tax deductions. For example, you can contribute to a donor-advised fund to fund your charity donations to accelerate your charity tax deduction. And these are just a few examples, but there are several more ways to structure how you move your money to increase your tax deductions. So if your back is against the wall and you're looking at paying more taxes, just know that there is almost always something you can do if you plan in advance. And the 9th most missed deduction is everything else. Now, this is a catch-all point, but it is still worth pointing out. Section 162 of the Internal Revenue Code says that you can deduct all ordinary and necessary expenses paid or incurred during the taxable year to carry on any trade or business. So even if the deduction you are missing out on is not on my short list here, if it meets this criteria, then it is more than likely deductible. So examine everything you spend your money on and ask yourself, is this deductible? If you use it for any portion of your business, then figure out how you can deduct it. But anyway, if you made it to this part of the video, then this tells me one or two things. Either number one, you really enjoyed this video, which I hope, or number two, you have a serious problem with your current tax preparer. Maybe they are not planning with you at all, or maybe you're filing your own taxes, which is why you're here on YouTube. But unfortunately, a lot of the information here on YouTube is general information, and you still would have to connect the pieces yourself. So look, if you want to get off of YouTube and get on an actionable tax plan once and for all, I invite you to become an exclusive client of mine. And if for some reason you are not ready for that, then I also invite you to buy my Tax Savers course, which provides an actionable framework to reduce your own taxes. Or if you just want more in-depth guides from me, specifically for businesses, then consider subscribing to my division's YouTube channel, which is My CPA Coach. As always, thank you for watching, and I look forward to seeing you soon.